I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Tom Lee begins with a straightforward explanation. Crypto is still feeling the ripple effects of the massive April 10th deleveraging event, the largest such event in history. Even weeks later, several market makers are still repairing balance sheets and attempting to raise capital. What does that mean practically? It means that every time the market rallies even slightly, sellers emerge, not because they're bearish on crypto's long-term prospects, but because they're raising cash to stabilize financial positions. This has created a persistent ceiling on price action, suppressing both investor enthusiasm and momentum. This also explains why crypto has underperformed equities since October 10th, despite healthy risk sentiment and strong performance in the stock market.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Ether's down 8.5% this week. Bitcoin's down 8%. Bitmine is down 20%. What's happening here?
Scott, I think we're still seeing the repercussions of that April 10th crypto deleveraging event. It was the biggest deleveraging event ever. And there are still, I think, some market makers that have some balance sheet issues that are trying to raise capital. So I think that this is leading to a market that is kind of raised. Every time we get a bit of a rally, there's some capital trying to be raised. And I think that's what's suppressing crypto for now. That's, of course, going to end soon, but I think that's led to why crypto has underperformed equities since October 10th.
Can crypto treasuries, like yours, for example, can they trade as well or in tandem with a cryptocurrency itself, or does one have to trade at the expense of the other? If I'm going to see money flow into Bitcoin or crypto treasuries, wouldn't it then come out of the actual pure play coin itself?
Not exactly, Scott. For instance, when Bitmine has shareholders and institutional capital comes in, and JP Morgan, Invesco, BlackRock are buying big stakes, then that capital is then used to buy Ethereum. So it's actually going back into the ecosystem, but then it's going into a vehicle like Bitmine that's actually a permanent holder. Bitmine owns 3.5 million Ethereum, more than 2.9% of the supply, but now that is not going to be subject to liquidations because there's no leverage used to hold that Ethereum. And then at some point, that 3.6 million or 3.5 million Ethereum is going to be staked and then generate nearly $400 million in net income. Well, that can create returns for shareholders. So in a way, a crypto treasury is actually a pretty attractive equity because there's an income component, plus there's, of course, that ability to grow your Ethereum holdings per share.
But what if crypto treasuries become more favored than crypto itself? There's no negative impact for either the way that Ether or Bitcoin would trade if just more money floods towards the treasury part of this story?
Well, one, it's a conduit because, as you know, equity managers, many of them, the 4,000, can't own crypto directly. So they have to get exposure to Ethereum by buying a stock like Bitmine. And Bitmine is the 438th largest stock in America today. It's not that different than if someone wanted to have exposure to energy. They can buy oil and trade a commodity, or they can take like oil barrels at home, or they can buy an oil-related stock, either a major or something in the supply chain. That's what crypto treasuries are, is essentially an asset class that gives you direct exposure to the crypto asset.
All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be after what we've seen this week?
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAI went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. In fact, maybe over 7,000 by the end of the month. We should expect from time to time profit taking because tech has been a leader for the last decade, and it is overbought. So I think it is going to be from time to time going to show extended weakness. But to me, the underlying story driving technology, which is the productivity miracle coming from AI, is still intact. Mary Erdos even talked about this earlier this week from JP Morgan that there's been a payoff in spending, and Lisa Su at AMD as well as noting that productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks.
Tom, if I could just follow up, you manage funds now, especially an ETF that's heavily tilted in some ways towards some parts of that kind of technology, media, and telecom trade. Has anything changed with regard to the price action or the fundamentals that have taken some of those names perhaps out of your portfolios?
Dom, we just actually did a rebalance for the Granny Shots ETF, our large cap fund. We still actually have about 40% exposure to tech. It's about a market weight. But to us, the visibility and the spending is still very strong. And names like NVIDIA are still reasonably priced. I mean, NVIDIA at 28 times forward earnings is still less expensive than buying Walmart or Costco. Costco is almost 50 times forward earnings.
Tom, the tariff tantrum issues aside from earlier this spring, specifically in April, we haven't really seen any kind of a pullback last that long. It seems like these things are getting shallower, they're getting shorter in duration. If it is the case here, does it still play out that way? And if so, what exactly then goes on shopping lists? I mean, you mentioned your ETF GRNY, Granny Shots. Is there anything that you would be thinking about buying more of? I know that the rebalance is already there, but what kind of stocks actually go and you want to buy on discount here heading to the year end?
Yeah, well, I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means the ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback, but for the last 5 years, investors have had to buy that pullback.
Shifting from Tom Lee to the second analyst in your text, we explore a deeper cyclical analysis of Bitcoin dominance, BTC.D. Bitcoin dominance is likely headed higher. Even though investors are uneasy about short-term price action, we're still in a strong upward trend. Dominance has risen for 8 weeks. Pullbacks are normal, but not trend-changing. Quantitative tightening hasn't ended yet. Historically, Bitcoin dominance often peaks in post-halving years. The macro top in dominance tends to occur during quantitative easing, not tightening. This cycle aligns strongly with that pattern.
I'm still of the opinion that dominance is going higher in the short term, right? And a lot of people have asked, like, well, why is it crashing and whatnot? But guys, when you zoom out, it's been moving up for like 8 weeks in a row, right? It's not moving up as quickly as perhaps I would want, but it's a lot easier to know what way the wind is blowing than to know exactly how fast that wind's actually going to blow. And again, I think dominance will likely continue to trend higher. Now, one reason for that is that quantitative tightening, while it will end, it hasn't ended yet. And at least last cycle, we know that Bitcoin dominance actually topped in the post-halving year. Let me actually go back. It actually topped in the post-halving year. And while it was not the macro top for Bitcoin dominance for the cycle, it was a top for a while. Remember, the actual top for Bitcoin dominance last cycle occurred during quantitative easing. Okay? So that's an important thing to remember as well. But I could see a scenario where Bitcoin dominance goes up a lot and then it ends up topping right around when quantitative tightening ends in early December. One of the reasons why early December makes a lot of sense is because a lot of the larger coins tend to bottom out against Bitcoin in early December. For instance, if you were to look at the ETH Bitcoin pair, I mean, look at all the prior Decembers. You know, this is December of 2016, December of 2017, right? Early December of 2017, December of 2018, right? That's early December of 2018. And so on and so forth, right? You could even go look at December 2015. Here's December 2019, right? Like the list goes on and on. December 2020. There are some exceptions. For instance, December 2021 was a high for ETH Bitcoin. But I tend to think that ETH will continue to drop against Bitcoin into early December, just like it normally does. And so because of that, it's going to likely allow total 2 minus USDT divided by Bitcoin to drop into early December. And in some scenarios, drop back down to the lows that it was at back in June. So thinking like it coming back down like this into December and then bouncing off of that seems like a very likely outcome. And if that's what happens, then to me, it would suggest that Bitcoin dominance should continue to go up. Right? Like that's what would make the most amount of sense. Furthermore, we know that the dollar continues to go up, right? Like that continues to increase. And so with the dollar going up, that tends to usually mean that alts drop against Bitcoin over a longer period of time. But you can see the dollar has been slowly trending back up. And this was kind of what we talked about before, was that it would likely form a low like it did back in 2017, 2018, and then begrudgingly start going higher. And it seems like that's exactly what's happening. So it's another reason why all Bitcoin pairs should continue to bleed. Now, we also mentioned that while they will likely bleed, there's going to likely be a brief relief by alt Bitcoin pairs in early to mid-November. You can see last week was green. This week is currently green. Very similar things happened in prior cycles as well. For instance, you can look at 2020, there was a 2-week November green period right there. Also in 2017, there was a couple of weeks where all Bitcoin pairs kind of went back up a little bit. So you're getting that relief, but ultimately it'll probably drop back down by early December would be my guess, and that should allow Bitcoin dominance to go higher.
According to Tom Lee and the cyclical analysis we examined, we are in a temporary but healthy consolidation phase, both in crypto and equities. Institutional structures like crypto treasuries are maturing, the Fed is signaling eventual clarity, and AI remains a powerful secular driver of growth. Meanwhile, Bitcoin dominance is likely to keep rising into early December, aligning with years of historical seasonality, macro conditions, and capital rotation trends. In short, volatility now, opportunity soon.